Hello, I'm Adam Grimes, and welcome to Module 2, Unit 3 of the Art and Science of Trading. Today's topic is support and resistance, the battle of supply and demand. How do you like these dynamic subtitles, right? So this is an important idea, and it is one of the most significant, most important teachings of traditional technical analysis. Now, like everything else, I think there's some problems and pitfalls and things we need to be aware of. And what we're going to do here, though, in this particular unit, is we're going to think about things in that context of traditional technical analysis. So that's where we're starting. I'm going to teach you the standard. I do want you to take all of this with a big grain of salt. We'll talk more about where this can go wrong and what we need to think about. We're also going to talk very soon about trading ranges. Trading ranges are the aspect of markets where we really see support and resistance come into their own because they define those ranges, and it's where we can see the action, support, and resistance very clear. So as we dig in here, be careful. This is one of the most overused and abused concepts in technical analysis. You need to be aware that your eye will happily create support and resistance levels out of nothing. I can give you any chart, and I'll show you examples later. We don't need to do that now. Any line I draw on a chart is going to look important to you. And for instance, I'm convinced that in many cases, one of the reasons people think that round numbers are important would be, and by round numbers, I mean whole numbers. Why? Because many of our charts have horizontal lines on round numbers. And if we have a line, our eye is going to be drawn to the action there. We're going to think there's something important there. If you do start to really get into support and resistance levels, and see, I'm giving you a lot of pieces here, and I know people are going to focus on different sorts of things. And if you decide that you're really turned on by support and resistance, the questions you need to ask are right here. And they're not easy to answer. We'll talk about that later too. Are your levels better than random levels? So basically, this is a way of saying, do your levels really work? And you're going to come back and say, yes, they are. And I'm going to say, how can you be sure? Because again, you can't really trust your eye. Your eye will happily create levels where there are no levels. So another question you should think about is, what levels will you use? Will you use calculated levels, Fibonacci levels? Will you use pivot levels? There are all kinds of different, we just talked about pivots in the previous unit, but many people will call these calculations based on ranges pivots. We use moving averages would be another example of calculated levels. Trend lines, I suppose, could be a calculated level. Will you use visible chart points? And I think this is probably where we want to start. So good support and resistance levels are pretty obvious. So important previous highs or lows, things that just jump out on the chart and smack you in the face and say, pay attention. Previous pivots can be important. Now, as you saw in the previous video, not every pivot is important, but if you have a pivot that happens to line up with a significant high or low, it's probably worth paying attention to. One thing you might think about is, does it matter if the market is trending or not? Because we do get in situations where the market will move in one direction. And if you're always looking for some type of action with resistance on every rally, you'll probably be disappointed until you're not, which will happen. Traditional support and resistance. So these are levels at which supply has been able to arrest rising prices, or demand has been able to overcome declining prices. That's the theory. Now, notice this is written in past tense. So if we're looking at a chart and we see areas where basically buyers and sellers are always fighting it out, and you reach a point where the buyers kind of get overextended. The market's gone as high as someone wants to pay, and the sellers start winning, supply and demand, and that is what makes these support and resistance levels on the chart. That's the theory, at least. There are patterns associated with these levels failing or holding, and these patterns are primarily on lower time frames. Another thing, and so these are all, this is not Adam says, this is traditional technical analysis says. So this is TA 101, support and resistance. And number 3 here is support once penetrated becomes resistance, and vice versa. I'll show you some examples. And this is maybe more Adam than traditional, but best levels are very visible on price charts. Again, we'll look at some examples. So price action around support and resistance. This is important. If I had a bell, I would ring it here. The characteristic pattern of support and resistance holding is price rejection. I must just say that again. The characteristic pattern of support and resistance holding, working, is price rejection. What is price rejection? It's an immediate and sharp move away from the level. It seems as if price doesn't want to be there. I'm going to go ahead to the previous slide. I'll come back. So here we have just look at the line. It's a short-term moving average, but look what happens. This level is defined. You can't see where this level is defined, but it comes from something that happened over here off the chart. The market trades down to the level. What happens? We get to the level, and right away, there's a very sharp move away. There is no doubt, no question, prices do not want to be there. This is a classic example. It's in my book, actually. It's a classic example of price rejection. If there is no price rejection, the probabilities begin to tilt toward support and resistance breaking. And so if we just think of these, look in the bottom right-hand corner here, here's your support level. Market's coming down to your support level. Price rejection, right? Hits the level, and it's obviously not going to be that clear. That's one way we might see price rejection. Another way we might see the failure of that price rejection, here's your level, the market comes down, maybe it bounces, and then maybe it sits on the level. So you see there's a comfort here. When we see this, it's much more likely we're going to slip through the level and continue to trade lower. So price rejection, I'm saying this 5 times for good reason. Price rejection is the characteristic pattern of support and resistance working. If we do not see price rejection, we start to think that support and resistance is more likely to break. And one of the tricks, particularly for your homework, might be to use a short-term moving average just as a tool to train your eye. What's a short-term moving average? 2 to 5 period moving average, which is, I don't know exactly what's on this bar, but it looks like might be a 3 period, 3 or 5 period, I don't know. And here's lack of price rejection. So this is, I want you to not just think of this from one side. So this is a resistance level. And how do we define this resistance level? We define it because somewhere in here, we would be able to say, oh, look back here. It's like this pivot stuff. It's not obvious at the time, but by the time we get over here, it's pretty obvious that this is kind of an important isolated high, and we're happy with that. And so then what happens? Well, the market, nothing's happened here, right? Here's our first test. What happens on the first test? Is that price rejection? I don't know. It's not convincing price rejection, right? Convincing price rejection would be down here, but it does appear that we came up to this level and didn't really want to be there. But then what happens? We go back and we come off. Look, if you're just looking at very visible pivots, you have these higher lows into resistance. This is a type perhaps of a cup and handle formation if you know your classical charting patterns. But what you're seeing here is then look here, look at the price bars behind there. Could you see through the moving average and see the gray price bars? We're just sitting there on that level. And this is a very typical pattern when support and resistance breaks. So let's just look at these back to back. And maybe this is complicated because one's going down, one's going up, but you got to learn to think both ways, right? So price rejection, come down, hit this support level, and then boom, we are off very quickly. No price rejection, the level breaks. We go up to the level, we come off a little bit, we hug it, and then we go through the level. So that is the most important pattern to look for. Now, these are carefully selected examples. In real market action, it can be trickier, and markets will specifically do things to fake us out, but this is still the concept. So levels to use for now. Well, it needs to be obvious. And you just saw an example where one level was very obviously just a point on a chart that stuck out. Pivot points, particularly pivots that are at very visible chart levels. these, which will almost always be pivot points. What are visible? So extreme highs and lows, areas that have stopped price in the past. Sometimes you'll see things like this where you have multiple tests. One important thing is that these support and resistance levels are not exact levels. They're broad general zones. So when we get into an area, we start to think maybe something's going to happen here. Presence of long shadows through or into the level seems like a paradox, but this actually strengthens the level. So if we see, let me see if I can draw this. So if let's just say we kind of have a large kind of fuzzy area here, and we have the market trading down from it, and then we come back up to it. Now, are you going to want to see this type of action, or would you rather see this type of action? Many people would say that this is not good because the level actually broke. But what has actually probably happened here is we've had price rejection on lower time frames. And these shadows are just, it's a candlestick terminology. It's the part, this is the body of the candle. These are the shadows, which some people will call wicks, and this is the body. They're just areas where basically the market probed but could not find activity. Those actually strengthen the support and resistance level. These really need to be obvious. They need to jump out on the chart. There are no hidden levels. I think it's the first thing I have colored and used colored text in this entire course, because it's very, very important. There are a lot of people who will tell you there are all these secret hidden levels. Well, that's a great way to sell you crap. Just to just to be perfectly honest, that's you can come up with all of these secret ways to calculate these levels, and then your cognitive bias is going to kick in. If I tell you a level is important, you're going to start seeing it as important, and that's why people sell a lot of garbage. But if you want to use support and resistance that really work, this is extremely important. There are no hidden levels. It's got to be obvious. Got to be stuff that just jumps out of the chart. This is that idea of resistance once broken becomes support. So we have a resistance level here tested. Now that it's broken, we can expect some type of retest. And the same thing would happen with a support level, that once we break the support level, we expect when price comes back up that it will act as resistance here. Now, is this a real thing? Many of you are saying, the fact I'm even asking this question, many of you already think I'm a complete idiot. And I'm going to get into some deep quantitative tests I've done on some things later, and I'll tell you the answer here is we just don't know, because this kind of thing is very difficult to test. It is a little bit subjective, and the best we could do would be to do some kind of really rigorous by hand testing. Even then, I think we're very vulnerable to this cognitive bias, and I've decided it's not worth my time. So this is a concept that I would not place much weight on, even though you will see many people tell you this is one of the most important concepts of technical analysis. And if you take certification courses, you will have to believe this is one of the most important things in technical analysis. We talked a little bit about this. Two things working together here. You have a resistance area here that is in fact a large area, and you might at this point have defined it here, and we went through a little bit, seems to be holding. But then what happens here? Is the level broken? Or have we don't know this in the past, but have we simply expanded so that now we're kind of looking at this broad zone? This is really the way that I find is more productive to think about support and resistance. So you're not looking at precise levels. You're also not going to expect razor clean knife edge tests. You're going to have a lot of garbage. And by the way, let's teach multiple concepts here. Look, potential resistance level. How do we know potential resistance level? Well, it's a very clear and obvious level in the chart, right? Where's another one? Back here. So we had a potential resistance level here, which I don't think I drew a straight line, probably actually would have held there. and then broke here. What happens? Well, so here we're coming up to this level. Is this price rejection? Not great price rejection. Market turns back up. We go through. Same thing is happening here, right? So we're looking here. Maybe we have some idea here that this level is important. I don't know when we really legitimately pick it up. Probably here. Actually probably here. So we're on guard here. What happens? Look at that. That is pretty convincing price rejection. We go up, we just tag the level, and then if you're doing your chart stories, there's some good downside momentum there. That's what we're looking for. Then what happens? We're back, right? And now what happens? How much price rejection? Not that much, right? And you see, this is a real world example. And I don't know what goes on here. Again, I definitely could explain to you every single bar with having some significance, but it's really not true. More important is what's going on in terms of the big swing structure. Well, here's your test, price rejection. Back up, a little bit of a higher high. Let's call this one swing down. Back here, resistance holds, so not much price rejection. Not much price rejection at all. And you're starting to tell a story which suggests that this level is probably going to break, which is in fact what happened. I think we covered this a little bit too, but here's just an example of multiple tests. One of the things that traditional technical analysis will tell you, which frankly is a little bit baffling, is the more times a level is tested, the more likely it is to hold. You can do your own work. But this is, very particularly when we start to get this, what is happening? Well, look, so this is not a level, right? At this point, this is not a level. Where does it become a level? Somewhere in here. So my point is, this swing is real. We can't really say it's related to support and resistance. But once we get back down to the level here, pretty good price rejection, right? And then we're back. And not so impressive price rejection. And then we start to do this thing where we're just consolidating, and that typically will set up a break. So that's how this works. Here is another example. This actually probably, these next charts aren't so important because I've talked so much, but just look. So here you have your resistance level defined maybe somewhere in here. No price rejection, consolidating up against the level, through the level, and then here the level holds as support. So this is this idea that this previous resistance, once broken, becomes support. And the market comes back to it, and it still appears to be support, and it's broken. What do we expect probably happened? Well, if we believe technical analysis. And why am I being so critical of this stuff? Because I want you to be critical. I want you to think critically, and that's the way you're going to. The market's going to be very critical if you're trading. So the more critical you can be, the more of a scientifically minded thinker, the better trader you're going to be. And last, here's a chart that gives you some idea how complicated these things could actually be in real time. So just take a minute to look at this chart. I'm not necessarily going to go through and talk about every single pivot. I'll leave this up here actually while I do a little bit of summary and review. So in this unit, we've talked about support and resistance, which is one of the most important concepts of technical analysis. We do need to be careful because cognitive biases really can hurt us. Any line will look important to us, and it can be very hard to test these just because, particularly subjectively, we're going to think any line we put on a chart is important. One of the critical things when you start to actually use support and resistance is, this is the first time I've said this in this unit, but you want to think about potential support and resistance. So you don't want to think that the market is coming down to a support point. You think it's a potential support point. Market is not coming up to resistance. Why do we not say that? Because if the market is coming up to resistance, what's going to happen? It's going to stop. That's what we're expecting. But if it's potential resistance, it might stop, and that's reality. It might or it might not, and maybe there are things that can tilt the odds in one direction or another. But regardless, this word potential is extremely important. If you ever find yourself thinking the market has to stop at that level, and in the heat of battle, you really might think that. You might have something where the trend has just gone on, or it showed all kinds of end of trend patterns, divergences or whatever it is that you look at, where you think the market has to stop there. But if you ever find yourself thinking like that, you're on very thin ice, because nothing has to happen at any time, at any level. Anything can happen, which is quite the opposite. Always work with the awareness. I think I've made the point multiple times here. Any line on the chart will appear to be significant to your eye, so you can't trust your eye. And for now, you certainly will progress and grow in this, but just use very visible chart levels as potential support and resistance, pivot points, clearly visible previous levels. Pay attention to those, and that should get you pretty much on the straight and narrow. So that is the end of our unit on support and resistance. I'll see you back for the next unit.